Hello, ladies and gentlemen. My name is Greg McCloskey from ForexLive.com. Today's date is March 8th, 2023. This is the Morning Forex Technical Report where I take a look at the technicals that are driving the Forex market. Let's get started. Of course, we know yesterday Fed's Powell had his testimony at the Senate Banking Committee, and his comments were more hawkish. That sent the dollar sharply to the upside. Interest rates, especially in the shorter end, up strong, with the 2-year up around 12 basis points. The 2-year is only up about 1 basis point here today, and the longer end is down as that yield curve continues to get more and more negative, with the 2s, 10s over 110 pips, I think, difference between the 2-year and the 10-year yield. So that is signaling a recession down the road. But in the short term, we have the Fed looking to raise rates by 50 basis points at their next meeting, which is taking place on March 22nd. Before then, we have the employment report on Friday. That's not expected to be any weaker or a weak report. Then we have the CPI data coming out next Tuesday. It's getting through those numbers, and they are not expected to be, negative numbers or anything like that. So it seems like the Fed is heading toward that 50 basis point hike. Let's take a look at some of the technicals that are driving the currency markets. We'll start with the euro versus US dollar. And when we look at this currency pair, we did move sharply to the downside yesterday. If we from a technical perspective, we cracked back below this broken trend line. We cracked below the 100. We cracked below the 200-hour moving average. And what was interesting at the 200-hour moving average and also this trend line right through here was that the market fell below this level and then came back and retested that level before rotating to the downside. You can see that on the 5-minute chart. If I go back in time to the 5-minute chart and look at yesterday's price action, this is the initial move to the downside. And you can see we corrected right back up to that 200-hour moving average, to that trend line level right here, and then sold off. So that was a key technical clue from traders, and the sellers took advantage of it and pushed market sharply to the downside. The price went through this swing area, went through this low here, even went through the low price from February 27th, it looks like, in trading here today, to a new low of 105.23.6. That's cycle low before the market started to rebound a little bit to the upside. We're currently trading at 105.40. It would take a move back above this low right here at 105.64 to give the buyers some hope that the low is in place. They have a little victory in the failure of the break of this low right here, but they would need to get above this level. They need to get back above this level and eventually above the 38.2% retracement as well of the last move to the downside. If you can't get above that level, then the sellers are still in control. There may be a corrective move in play, but the sellers would still be in control if you can't get above that level. So, we're not even near those levels right now. So the sellers still are in control in the short term. Let's take a look at the 5-minute chart just for giggles to see what the moving averages are saying. You can see that the consolidation over the last today's trading has allowed for the 100 and 200 bar moving averages to come back and play. The market is sort of waffling back and forth between this high right through here and this low through here, and with the two moving averages in between. If we start to move back below near the 105.33 level, that should open the door for further downside as this consolidation runs its course. If we move above the 105.46 level, we could see rotation back toward this 64 level and up toward these levels. We will see. Finally, I'll take a look at the daily chart because this is important. On the downside, we do have the 100-day moving average coming into play at 105.09. We need to get below that level. We haven't been below that level since this day right here, going back to November 10th, 2022. So getting below that would be important. Also, we still haven't reached the January low, which came in at 104.84. And if you get below that level of the 38.2% retracement of the move up from this low to this high right through here, that is also a key target to get to and through if the sellers are to really start to take more control in the euro versus US dollar. Let's take a look at the dollar versus yen next. And if we look at that on the daily chart, we did move above the 200-day moving average in trading today. That was the first break above that moving average since December 20th, right back here. So the market tried to get above the 200, but failed on that, and we are trading near the lows and trading here today as there is some corrective action in the dollar versus yen. Take a look at the hourly chart. What does it look like? Well, we're in this swing area here, which encompassed the high going back to February 28th, the highs that we saw back on March 2nd, and the highs through here where we sort of stalled before breaking above into the close yesterday. So this area between 136.91 and 137.09 is being tested on the downside. If the market is able to hold that level, that would be good news for the buyers. Let's put a Fibonacci just from this low to this high right here, in the 38.2% retracement of this last leg to the upside comes in within that area. So watch the 136.91 level for support. If the market holds support, then look for a break back above the 200-day moving average. Give the buyers more confidence for further upside momentum. Let's take a look at the sterling versus US dollar, and this is on the let's take a look at the daily chart first. On the daily chart, we are within this swing area. It's pretty wide, 107.59 to 108.40, so a little less than, somewhere around 80 pips in between this lows right through here and this low right through here. But you can see how the market, how that area is of significance. We'll define it as this red box here, where the market moved higher, lower, higher. Now we're back lower, and we'll see if the market can break below the 107.59 level over time and push the market further to the downside. What we did yesterday was move below this 200-day moving average. That's the green line in this chart. We had held support, done a pretty good job of holding support. Broke a little bit below it there, but quickly rebounded. But you can see all the different times the market held support against a 200-hour day moving average. So breaking below that level was key, and it opened the door for further downside momentum. Now we're into this bottom of this red box right here. We need to get below the 107.59 level before moving back above the 19.06 level. That's a 200-day moving average. That would be key. If we could stay below the 1.1840 level today, that would even be better. As you can see, we did try to move above it in earlier trading, but could not sustain momentum. Here is what it looks like on the hourly chart, and you can see the momentum through the 200-day moving average here, also below these lows right here, sent the price sharply to the downside in the sterling versus US dollar. Finally, let's take a quick look at the dollar versus Canada. Why? Because the Bank of Canada interest rate decision will take place at 10 a.m. ET. And the expectations are for no change in interest rates at 4.5%. Remember, at the last Bank of Canada interest rate decision, they put on that conditional pause. They use those words, conditional pause, to indicate that they were going to pause at this next meeting. So it would be kind of a surprise, I guess, if after they said that at the last meeting that they went ahead and raised rates this meeting. So the market is expecting no change, and that is helping to weaken the dollar Canada. As you can see, it moved sharply to the upside yesterday, moving above this range right here. It would take a move back below the 137.02 level in order to and then below the 61.8, below this level down here, 136.63, to get out of the more bullish bias here for the dollar versus Canada. On the top side, we have this high price going back to November 3rd at 138.06 as the next key target on the top side. Following that by this old high price coming at 138.35, and then we'll start to look at this high and other highs all through the year there. So that's what that currency pair is looking like ahead of the Bank of Canada interest rate decision. So there you have it, a look at some of the major currency pairs. My name is Greg Michalowski from ForexLive.com. Good fortune with your trading. Bye-bye now.